Hi, hello everyone. Good evening to every one of you. Ladies and gentlemen, this is Ashok Devanampriya. I am the CEO of Traders Gurukul and Strategon, an algo trading company. On behalf of Traders Gurukul, I'm extremely honored to welcome every one of you to Intrazon 2.0, India's largest retail traders online conference. It's a great news that in spite of we reaching the 10th session of the conference, we have people joining us in big numbers. That shows the interest and eagerness to know more about intraday trading strategies and models, which is a special theme of Intrazon. My sincere thanks to colleagues, management, and leadership of Money Control Pro for joining us as our media partner and believing in our ability or capacity to deliver such mass conferences on a bigger scale with wider participations of traders and investors and with interesting speakers getting onboarded. Let me also thank our title sponsor, Espresso, one of the leading discount brokers in India from the family of Sher Khan, who have close to 25 years experience in Indian equity markets. The speaker for today is Mr. Dinesh Nagpal from Kolkata. He is going to take us through to our journey on a special topic, multi-time frame trend signals using Ichimoku and harmonic trading patterns. He is a professional trader with almost 15 years of full-time experience. He is more focused on the concepts of Ichimoku, harmonic trading, and trading psychology plus risk management. Mr. Dinesh, on behalf of Gurukul, behalf of Money Control Pro and Espresso families, I extend my warm welcome to you into the program of Intrazone 2.0. Go ahead and excite our audience with your inspiring session. The stage is yours.
Thank you, Ashok sir, and thank you for having me over. And I hope to keep the audience grasp today in educate and add some more knowledge for them on this session today on how I have been using Ichimoku and Harmonics and trading psychology risk management. These factors, we'll speak about them now. So today, like Ashok sir said, multi-time frame trend signals using Ichimoku, and with that harmonic trading patterns. Now, two completely different studies. While one Ichimoku is a indicator-based study, moves based on oscillators. The other is a price action study. So two studies completely apart, complementing each other and being used to create trade setups. Both can do it individually, both can do it in a combination. So how we use it, we'll cover that now one by one. So before I push ahead, I'm not a SEBI registered advisor or financial advisor. This is purely on education purposes for the listeners today, and it's an educational one, totally to teach you how the whole system works, how I've been doing it. There may be many other what you call much better than me or in line with what I say, but in the end, it's everything comes to discipline of technical analysis or any other derivative data study that you do and how you manage your risk. So please do your own research in the end before taking a trade decision. So a little bit about myself. I have been active in markets since 1989, since I graduated from college. After that, what initially started, with IPOs, then went to trading, saw the Harshad Mehta era, the dot-com bubble, the 2006 global metal meltdown, then the 2008 subprime crisis, and so on and all. I've been extensively using Ichimoku and Harmonics for all purposes. That is, from intraday trading to positional trading, whether it is derivative or cash, and from investing in weekly, monthly charts. So for everything, that's my go-to study for these two. Besides being a full-time trader come investor, I also teach, mentor, coach on all the three topics, which I call my hit sessions, that is harmonics, Ichimoku, trading psychology, risk management, because I strongly feel that analysis, be it technical, be it derivative, be it fundamental, can be outsourced. Today, every broker or every analyst is giving their view, etc. You can get them all over the social media, but in the end, it is trading discipline. Without trading discipline, you cannot make money in the market. Whether you're doing it as an investor, whether you're doing it as a trader, it's very important to understand what your risk management is. So for whether you are a risk seeking individual or you're a risk averse individual is very important, and that's where the risk management comes in. One person can be happy with a 10,000 rupee profit, but the another person may be not content with 1 lakh. So each individual will have their own nature characteristics, and that's how one has to stand apart from the other and not be an absolute copy paste. So this is what I train and I teach. One can look out for me in my Twitter handle and or through my YouTube videos. Now, Ashok sir, if you could just.
Yep. So friends, the broker, the title partner for this event is Espresso, the Sharekhan company. Okay, a discount broking firm, one of the well-known discount broking firms in the country. They are the early adapters of online trading system in India. So the speciality of Espresso is that they don't charge you money for loss-making trades. No brokerage will be charged for any delivery-based transactions. It's a great effort by them to find right value prop for the new generation of traders and investors. Thank you. Over to you, Dinesh sir.
Yeah, so we start first with harmonic patterns. Now, harmonic patterns is derived from the structure, a shape, a movement is making. Now, prices don't go from A to Z, that is from where a bottom is made to where an ultimate top is made, or vice versa, in one straight line. They go up, they go down, they go sideways, they go push up and down, remain. Sometimes it's volatile, sometimes. So it's all on human emotion and psychology, which moves prices going forward. So it's a shape, and then there is the price, the ratios which match up. So structure and ratios combination is what we get harmonic trading patterns from. Now, the trading, the subject harmonic trading patterns has been used in the Western world since the turn of the century, but the study is very old. It's very old. So the structure idea comes from Ralph Elliott of Elliott waves and Gartley, on whom one of the harmonic patterns have been named. So they talk about the structure of the movement, and the ratios, that is the numbers, come from W.D. Gann and from Bryce Gilmore, the one of the authorities of market geometry. So we are combining points and shapes to come out with ideas of a trade setup. So pure price action using this analysis. Now this is what the structures look like. This on your left of the screen is the Elliott wave. Now Elliott wave is something, it's got waves, 5 waves up, AB corrective, again a 5 up, again a corrective, again a 5 up. Once the structure is done, then the turn comes. So impulse corrective, impulse corrective. That's the shape of the movement coming out of it. Similarly, Gartley, the Gartley pattern, he wrote about it all the way 100 years back in his books, that prices make shape structures. So here we can see a kite-like formation out here, an ABCD, making up another big ABCD. So he is a pioneer of the Gartley pattern as well as the ABCD, the most easiest to spot to the eye, 4-point pattern, and it works in all time frames. So this takes care of the structure part. Now comes the numbers. How do they? Otherwise, I can draw any structure and I can put it up and say this is a Gartley or this is a wave. No. So here comes the ratios into place. Now, Gann was a master genius when it came to astro, when it came to numbers, the square of 9, and a lot of about thing is absolutely amazing on the way he had a very high level of accuracy, just like Ralph Elliott had with Elliott waves. Now, the other gentleman, Bryce Gilmore, market geometry genius, he spotted that what Gartley was making in his patterns were respecting Fibonacci, and same, that is the principle of using Elliott waves also. Now, it would be, worldwide, we consider Leonardo del Pasa as the man who developed the study of Fibonacci. Now, Fibonacci is something which is a set of numbers working in a certain principle and overlapping. They are found naturally. They are there in the planetary orbit. They are there in a plant. They are there in a leaf. They are found everywhere in nature, the Fibonacci numbers. So they started using that at that time for their constructions. Even the pyramids are on Fibonacci ratios, like that. But the interesting part is that Fibonacci was extensively being used in India 700 years before Leonardo del Pasa made a literature. And of course, they are the Western world, they were the more developed countries, so they take all the credit away. In fact, in India, between the year 600 to 680 AD, there is Indian literature which says that Virahanka was using Fibonacci. Then from 1135 AD, Gopala was using, and then finally Hemchandra in 1150. Leonardo del Pasa has come much later than. So it's there in our markets, but the Western world developed it, used it. So keeping all this in mind, that nature inspires price action behavior. Whatever happens, it's a natural process. Patterns repeat themselves, structures reset themselves, and accordingly, hence we have pullbacks, hence we have throwbacks, hence we have rallies and corrections. Now, harmonic patterns took the study, used the combination of all this, doesn't want to get into the complex of Elliott wave patterns or structure, doesn't want to get into the depth of GAN. So tried to make it easy and not, and tried to work on the shape. Now the shape for a bullish one would be an M-like structure where a price has done a movement, done a pullback, and then pulled back and then finished a pullback. So that's the shape. When you see something like that happening in the market, that means now we are going to start to look for a bullish harmonic pattern, not a bearish one. So we are looking for reversal. Primarily, harmonic patterns are all about reversals. They are the first and among the fastest indicators, along with Elliott and Gann, which believe on non-indicator based moves and give reversal signals. Similarly, when a W is being formed, we look up and we look for a end of that particular trend, and then we will trade contra to that trend. But now that doesn't mean that every W and every M are going to just jump in and fight the trend. No, they have to respect certain ratios. Every harmonic pattern will have a ratio, a specific ratio which must match. So we are saying a pattern matching a Fibonacci ratio, then we call for a reversal of trend. So here's an example for you. This is in the 5-minute bank Nifty setup. Now here we have a bat, a bullish bat setup out here. So once the structure is complete, now this looks like an M to you out here. Once the structure is done, we now start looking and trying to confirm the ratio. Without the ratio confirmation, we will not jump into the trade. Now, the best part is we don't have to just look at one ratio. We can look at it from 4 ratios point of view: the XB ratio, the XD ratio, the AC ratio, and the BD ratio. So when the ratio table gives us a signal to buy, we go for the trade, and this is the kind of reversal which is anticipated. So contra, indicator-based studies will not give you a signal so fast, because indicators work on oscillating systems which look at the data on the past few candles or the number of candles set in the system, and they will turn much later once they get a confirmation of turn. But Fibonacci based, price action based will not work like that. They will give you the signal beforehand that this is how the turn is going to happen. This is where the turn, this is the entry, this is the stop loss, this red candle out here, this is the entry, this is the turn. Now, how do we justify the target? We draw trend lines. We make it that simple, just drawing trend lines which we learn to make in our school, in our basic geometry and drawing classes. So drawing a line, bounce back, pull back, again starts. So makes a higher low, higher low, further higher low. Pull the trend line upwards if you haven't got out of the trade till now, if your trail has not been taken out, and then run the trade. Breaches above the trend line, continue holding or run it, use the next trend line like that. So it's that simple, does not require any indicator. Of course, you can add indicators to your study and try to complement it and use it to your advantage. But even independently, it can be used just purely following its structure and the ratio matching. So it's a natural process of pattern formation which gets respected. Now this is the bearish one. This one is again in Nifty. This is a Cypher pattern. So ratios are matching. There's an XB ratio, there is a AC ratio, there is a BD ratio, and there is the XD ratio. We have a setup out here which says a sell with a stop loss at X out here. Or if the ratios go wrong. So we have a double stop loss system, and accordingly we look for a turn in the trade. And here we have from here the turn. Now, very simple, you just draw the trend line, pull it out, and let it show. This one didn't, this did a very minor pullback and came down all the way down to the target. Ideally in harmonic patterns, we look for a 38, 50, 62% retracement of the CD line, ideally. But whatever extra we get is a bonus for us in the reversal trades. Harmonic trading patterns work in all time frames. Now there are over 25, 30 patterns. Some of them are a few years old also, but I don't like to use them. I restrict myself to 15 patterns, of which have been being used extensively for the last 20-25 years, and they work not only in our markets, they work in cryptos, they work in currency, they work in commodities also. So back tested, done properly, being used extensively, and the indicator is there in most softwares today because it's using Fibonacci. Now the other study which I work on is Ichimoku. Now, this is purely indicator based. So one